Welcome back, everyone. Just a few moments ago, we had some of the biggest companies report their earnings. Amazon, Apple, and then we're also going to be looking at Booking Holdings, which is a smaller company, but it's a new one in my portfolio. So I'll be looking over these earnings reports. This isn't going to be like a super in-depth look. It's not going to be extremely nuanced, but I just want to take a look at it and get the first impressions and see what's going on with the fundamentals of these businesses. Now, the first one we'll be looking at is Amazon. If we just take a look at how the stock is reacting, it's a bit volatile right now, as you would expect. Amazon is a big company, tons of bots in the market and traders and options trying to digest what just happened. Right now, the stock is down 3.6% or 3.2%. It's moving around a lot. Just a minute ago, it was down like 6%. So we have a lot of volatility. Again, now down 2%. So we're seeing this thing trade around a lot. The point I'd emphasize is whether or not the stock goes down or up after earnings should not inform you of how the quarter was. In many cases throughout my history investing, I've seen companies post incredibly good quarters, really strong ones where the stock goes down. I've seen companies post really good quarters where the stock goes up. And a lot of it's driven by technicals and things not related to the ongoing fundamentals. So it's down around 2% right now, but I don't think that's a big deal. Now, when we're looking at Amazon's report here, I just want to mention I'm a shareholder of the company. I currently have $77,000 of value in it, currently $19,000 in the green. I've staked a lot of the performance of this portfolio, the story fund, in Amazon. It makes up 34% of the entire portfolio. So it's way overweighted from the QQQ, from the S&P 500. I have dramatically overweighted Amazon, and I've done so because I believe the company has a strong potential to outperform. Now, just to briefly go over my investment thesis before we jump into the earnings, I'm investing in Amazon because they are the first place in cloud. They're the first place in online retail. They're the third place in advertising, and they're the second place in video streaming. So they have these huge positions of concentration and dominance in different important markets. And typically companies that do that, the ones that are the winners, are at the top of the funnel. They control what's going on. I believe Amazon is an incredibly powerful company that will generate enormous incomes because of the segments they operate in. Now, I also believe, as part of the thesis here, that we're going to see explosive upside in Amazon's free cash flow. They've had years of negative free cash flow, big investment and capex heavy years. And I think now it's time that we see the fruits of what they've done. We see the harvest. It's time for Amazon to generate enormous amounts of free cash flow. My estimates are around $70 billion in 2024. And in order to do that, they have to have some quarters where they put up some real free cash flow numbers. And then in terms of the valuation, if you assume Amazon's going to make $70 billion of free cash flow, the company's not that expensive right now. So it's an undemanding valuation based on my expectation. So that's the thoughts behind it. Let's go ahead and see how things turned out. We can first take a look at the headline news and see how CNBC is reporting this. Amazon reports weaker than expected revenue for the second quarter and issues disappointing guidance. So they came in short on revenue and the guidance was disappointing. Let's go ahead and take a look at the actual numbers here. The earnings per share were $1.26 versus $1.03 expected. So earnings per share was a beat, but with Amazon in their current situation, the earnings per share is not the most important thing. The most important thing is the revenue and the free cash flow. So having the revenue be a miss is hitting the stock right now. That's again the reason that it's down a little bit. If we look at this, once again, it's down 4%. So it's down because they missed on the revenue and because they gave what's so far considered disappointing guidance. Now, AWS was a big part of this. This is something that investors look at a lot, and it was a beat at $26.3 billion versus 26 expected. So they had a slight beat with AWS, and that grew at 19% year over year. 19% growth with AWS is very strong. The expectations from investors it would be a disappointment was around 17%. So seeing AWS come in with a beat at 19% is a nice number. The advertising came in just under expectations, 12.8 versus 13 billion expected. So they had an important beat with AWS, but they came in just shy on revenue and advertising. So this so far is a mixed quarter. So that's how the news is reporting it. It was a mixed but overall disappointing quarter. AWS is actually a bright spot, but the advertising is a little bit behind. And overall, the revenue is a little bit behind. And I know that's disappointing investors because Amazon just reported a record Prime Day, the biggest one they've ever had. So investors had very high expectations. They're coming in a little bit soft. Stock is trading down a little bit. I want to take a look at some of the numbers here To put this in perspective, we start off with the online stores. This is the first party sales. It's the low margin business. This grew by 5%. Very slow growth. It's a big part of Amazon, but it's the low margin, slow growth part. This is just so they can offer other services. The physical stores are also not important. Physical stores grew by 4%. Again, it's just not an important part of their revenue. When we get into the important segments, it's the services portion of Amazon. The third-party seller services, which is important, grew by 12%. So we're seeing fast growth by these seller services. Advertising grew by 20%. There's a bit of a deceleration, of course, but 20% advertising growth is still quite fast. That's a healthy business. So this is going to be likely a $50 or $60 billion business in a couple quarters. Then you have these subscription services. This grew by 10%. AWS accelerated from 17% back to 19%. And then you have other, which is experimental, not important. The reason that I think it's important to look at this on a broken down segment by segment basis is so that you can see how the most important intrinsic value drivers of Amazon are doing. Advertising is growing really fast. The third-party seller services continue to grow really fast. The AWS business continues to grow really fast, above expectations. Overall, from the most important segments of their business, they're all doing really well. Now, if we want to look at profitability and see how the company's doing along that path, they have this chart right here. This shows the cash flows, and they do some different breakdowns with it. For example, we can look at the Q2 2024 trailing 12-month breakdown, and specifically of their free cash flow. That's this line right here, their free cash flow. And this is over the last 4 quarters, the trailing 12 months. When we look at that, it is now $53 billion in free cash flow in the trailing 12 months. If we go back just 1 year from Q2 2024 to Q2 2023, that same number was $7.8 billion. So they've gone from a trailing free cash flow of $7.8 billion to $53 billion. Massive influx of free cash flow. And you're seeing this step up every single quarter. Look at these numbers. We have $7.8 billion, $21 billion, $400 million, $36 billion, $50 billion, and $53 billion. Every single quarter, their trailing free cash flow continues to grow quarter over quarter. And you're going to see this continue. I think by the end of this year, this number is going to be in line of $70 to $80 billion. They're generating a ton of cash. So overall, my first impressions of Amazon's quarter is it's okay. Not amazing. They could have blown me away by beating in advertising, beating in AWS, and of course, topping their revenue expectations. If they came in with triple beats, I think the stock would be up, not down 3 or 4%. But I also don't think this is a bad quarter. It's really not. Amazon's doing great. It's up 22% year to date. There's been a little bit of shakiness in the market today. I don't think that this sell-off is any indication of weakness. We have a company growing AWS by 19%, growing advertising by 20%, growing its seller services by 12%. It's generating greater and greater amounts of free cash flow every single quarter. I'm going to have to listen to the earnings call to get a full view of what they plan on doing with their capital return policy. But my impressions are that they're not going to be doing any buybacks or dividends anytime soon. So far, my first impressions, it's a good quarter, but not amazing. Now, next up, we also have Booking Holdings, which just reported their earnings. This is a new addition to the passive income portfolio. The company is a buyback machine. They buy back so much other stock, and they pay a dividend. It's a new one under the consumer category. I just bought into it less than a month ago. I'm in the red a little bit so far, but I'm confident that this one will work its way back into the green, like most of these compounding machines do. Now, if we look over the thesis real quick on Booking Holdings, the reason that I bought into this company, I believe there's a couple things that are going to play out over the next 10 years. First of all, over time, people generally grow their incomes. They get to a point where they're more comfortable. We have a lot of people that are getting inheritance over the next 10 years, and those people are going to want to travel. Travel is an innate desire. It's not a short-term trend. And even though the travel industry has short-term cyclicality, it is sensitive to the economy. Overall, it's a long-term innate desire. It is a long-term secular trend of growth. So I believe that's going to play out for the next 10, 20, and 30 years. Now, this company is positioned really well to just grow along with that trend. Booking Holdings is the largest online travel agency. They have dominant market share, and they are a super profitable business. So they're a platform business that has really high margins. They have almost no CapEx, and they have very low amounts of stock-based comp. So it's an extremely high profit, high margin business with very low expenses, very capital efficient. They're the largest player. They're at the top of the food chain. That gives them a lot of leverage in negotiations with contracts and different companies. And I think that there's going to be regulation, as there are with every dominant company, but I think that the regulations are unlikely to meaningfully slow down the company. And then finally, their biggest competitors, companies like Expedia and Google, I don't think have the incentive to destroy Booking Holding. Google certainly does not have that incentive, as Booking Holdings is one of their largest advertisers on Google. So this is the thesis of the company. As the company trades down at low valuations, because there's all this concern about the economy or cyclicality, Booking Holdings is so profitable that they continually do buybacks, making it so they can do super accretive buybacks. It's the same type of dynamic we've seen with companies like AutoZone. So even if this one trades down, it's one that I think will be able to buy back so much of their stock. Now we have the earnings report here, and it's so good. This is such a good earnings report. If we look through some of these numbers, they're just solid across the board. We have nights booked, which is a KPI, of a 7% increase over the prior year. So more people are planning vacations and taking vacations this year than last year using Booking. Total revenue was up 7%. The net income was up 18%. On an adjusted basis, the net income was up 3% over the prior year, but the earnings per share, the most important metric in the case of this company, was $41.90 on an adjusted EPS, up 11% year over year. And keep in mind, this company was trading at a 20 forward PE ratio. So it has a low valuation, growing earnings double digits. Adjusted EBITDA was up to $1.9 billion, an increase of 7% over the prior year. They're still compounding, still growing, despite the very low valuation. I like the report of Booking Holding. Solid growth across the board, no red flags for a company that's trading at a decent valuation. I'm going to be buying more of this stock. At $3,600 per share, I'm going to be increasing my stake of this company by buying maybe 1 or 2 shares. Now, finally, we can take a look at Apple. They just reported their earnings. Apple's also a large position in my portfolio. I've held this one for over 5 years. It's now a $48,000 position, 31,000 of that being gains. So this has just been a massive winner. And my thesis of Apple has changed over time. The original thesis, I entered into the company 5 years ago. It was a hardware company becoming a software company. I love that thesis of transitioning from primarily hardware to selling services. That thesis has played out. So we have to look to a new thesis for the company. Here's the new thesis. The iPhone is simply overpowered, and it's unlikely to be disrupted. You can't come up with a better device. You really can't. I see all these new devices that are trying to recreate something different, and they're just not as good as the phone. And you can broaden this to the smartphone. Sure, there's other smartphones that are pretty good and they're competitive with the iPhone, but the point stands, the smartphone is simply overpowered, and as long as the smartphone remains the key device, the overpowered device in people's lives, Apple's going to maintain a massive market share with the iPhone. Because as they own that dominant device in people's lives, they've wrapped it around an ecosystem that creates incredibly high switching costs. In order to switch the iPhone, it's not just buying a new iPhone. I'd have to unlink all my stuff in my wallet, all my payment methods. I'd have to unlink all my photos, my cloud backups, my notes. Every single part of my life is integrated into the Apple ecosystem. Those switching costs are very enormous. It'd be so difficult to switch to something else. So Apple owns this dominant device. They have incredibly high switching costs. The App Store toll booth is a royalty on the growth of other companies. Every company that's going through the App Store needs to pay that fee. They make a fortune doing so. And then we have the newer parts of this where AI is enabling and enhancing the operating system, which basically just means that Apple is continuing to do what they've done previously, but now just enhanced with AI. It's just another thing to differentiate them, to enable their ecosystem and further entrench Apple's dominant position. And then finally, while all the other big tech companies like Amazon and Google and Meta are spending a fortune on NVIDIA GPUs and they have very high CapEx, Apple's not really doing that. So they're actually becoming a more capital-light business compared to the rest of big tech. They're allowing for most cash flow to be returned through dividends and buybacks. This company is also a buyback machine. So this is the thesis on Apple. Now, the reason that I haven't bought into this company lately is simply because the growth has been slowing a bit and the valuation has been a little bit higher. But overall, Apple remains a very high quality company. When we look at the initial stock reaction, we can take a look here. It's in the green. after hours by 1%. To give this context, Apple's up 17% year to date. So we have a company up 17% in the green after earnings. I think that's doing really well. We can look at the headline here. Apple's sales rise 5%, topping estimates as the iPad and service revenues jump. This is great. I'm glad that it's topping estimates, but 5% is really slow growth. You're barely growing above the rate of GDP. You're growing, I think, just above the rate of inflation. So the company's barely growing at this point. I'm glad that it topped estimates, but we have a company that's still not growing that fast. We can take a look at the breakdown and see what they beat and missed on. The earnings per share was a beat. So they beat on EPS. The revenue was also a beat. So we have a top and bottom beat from Apple. The iPhone revenue was a beat. The Mac revenue was a slight miss. I would say this one's in line. They missed by what, $100 million or even less than that, $10 million. Not a huge miss there. The iPad revenue was a strong beat. The wearable home accessory revenue was a beat. The service revenue was a beat. And the gross margins were a beat. So the only thing they missed on was the Mac revenue, and they missed by $0.1 billion. So a tiny miss in the grand scheme of things. Now, that's impressive. Every part of the company is beating expectations. I don't know how Apple does it. They just pull it off every single time. The company's amazing. With all those numbers, Apple was able to grow their earnings per share by 11%. Now, how can a company accomplish that? How can they grow revenue by 5% and earnings per share by 11%? It's because of buybacks. When you have a very capital efficient company that's able to buy back their stock every single day, day in and day out, they constantly eliminate shares outstanding. When the shares outstanding go down, the earnings per share goes up. So because they're constantly eating away at their share count, the earnings per share continues to grow at a healthy pace. So overall, the first impressions on Apple's earnings are really good. This is overall a great report. You have 5% revenue growth, a little slow. It's still a very mature company, but you have 11% earnings per share growth. That's really strong. And you have them doing well in every category. People just love Apple products. I think that's why you can't bet against this company. People are too addicted to the products, and there's nothing coming out that can compete with them. So far, Mark Zuckerberg has not shown how the glasses or the Meta devices are going to take away from Apple's products. So until that happens, I still think Apple's a good stock to own. Now, I have to throw in one bonus earnings today, and that's Intel. I just look at this, and honestly, at this point, I just feel bad. I feel bad for Intel investors. This is such an unfortunate company to own. It's down 18% after its earnings. And I looked at the numbers. We don't have to go in depth on them, but basically every single thing was a miss. They just came in under every expectation, earnings, and everything that you can measure in the company is really not going in the right direction. So you have a company that's down 18% on the day after earnings, after being down 5.5% on the day. Year to date, it's down 39%. This has been such an enormous value trap, and I've tried to warn against this company over and over again that it's just a really risky one to invest in. You're hoping for a turnaround play, you're relying on low valuation metrics, and you're ignoring the business and how complex Intel is to run. An extremely CapEx intensive, complex business with long-term contracts with different customers, very difficult business. And it's unfortunate to see the outcome here. That's going to be it for this episode. I hope you enjoyed. If you want more in-depth analysis on these companies, just remember that this was a first impressions video. I'll have more in-depth follow-up in the future. See you in the next one.